Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to rip through Twitter or X or whatever you want to call it, see what people are talking about, see what news is out there, and obviously I'm going to interject my financial opinions as we go. So let's dive in and see what's going on. If you want to follow me, it's at finding_finance. And if you want to join our community at finding-value.com, we do talk a lot about commodities, commodity stocks, and single individual and ETFs, all that stuff. So coming on down, we got Scotty. Scotty knows uranium. Cameco to Dow Jones ratio. Fly zone must be close. Last bull market, we can't, well, bear market here, I guess, coming around. We went through here, fly zone. We're right to the fly zone. I know Cameco was going up quite dramatically today being July 31st. And we could see a big outperformance of Cameco versus Dow Jones. And I think that time frame is coming. And hopefully it's right here and we get our big launch that everybody wants. And everyone's happy. Fingers crossed. This is compounding quality. It says 10 rules for financial success. Pay off debt. Budget. Invest in yourself. Focus on mental health. Create multiple income streams. Invest greater than 10% of your income. Read. Cut unnecessary expenses. Avoid lifestyle creep. And think on the long term. And he says, what else? Well, I'm gonna say this. Number one is not pay off debt. It's to never get into debt. That is what I did. I avoided all debt when I was growing up. So I never got into debt. So I never had to pay any debt off. So rule number one is not to pay off debt. Is to not get into debt if you're already out of debt or don't have any debt. Budget. That's up to you, but I don't budget. I've never budgeted. What I do is I never get into debt. And what I do is I want to invest the majority of my income as much as I can afford. But budgeting isn't necessary if I don't spend anything. And this was only when it was myself. When I was growing up when I was younger, if I didn't need it, I just didn't buy it. It says invest in yourself, focus on mental health. You can invest in yourself, and that could be time-based. It doesn't have to be money-based. Create multiple yeah, that's fine. Invest greater, yeah, that's good. That's the only thing I'd say is just don't get into debt and don't buy stuff you don't need. That's really cutting unnecessary expenses and budget are the same thing. If this is true, it is wildly bullish OFS as it doesn't even include the North American natural gas boom, which will also require incremental activity and higher baseline. Given the bifurcation of OFS over the past decade, I suspect the market is much tighter than people think. It says most forecasts had oil hitting 105 million barrels per day by 2030. We are currently on track to hit 105 million barrels per day sometime during 2024. That is crazy. So in the age of the climate crisis, the world has never consumed as much crude oil as it's doing currently, recovering from COVID-19 pandemic shortfall. And we'll see if we hit 105 next year. And just smash the forecast by 2030. This is Disruptor. He says, there's no housing shortage. Apartments under construction. 970,000 apartments under construction. The only thing I don't understand is how does this negate a housing shortage? How do you know that 970,000 is the right amount? This just says new housing units under construction in buildings with at least 5 units. It doesn't actually state what is required and how this basically fills the deficit or not. So I don't know. I don't know if it fills the housing shortage or not. At least what he is stating. Coming on down, it says current market expectations for path of the Fed funds rate. Pause. May 1st, 2024, 25 basis point cut. Additional cuts here. So that's the current market expectation. So we've come on up in July, and then it's basically pausing here and then rolling over. You guys agree with this market expectation for Fed funds rate? Powell is talking like he's going to continue to raise, but the market thinks a bunch of pauses are coming, and then some cuts towards the end of 2020 or middle of 2024. This guy says, I love Munger. The world is full of foolish gamblers, and they will not do well as the patient investor. I am a investor. I take long-term type investments. I look at the value, I get in, and I might be in there for a decade or more. And I don't know, just like Charlie, if a foolish gambler can do that. So good luck. John says nearly a quarter of homeowners say they are considering selling their home in the next 3 years or have their home currently listed for sale, a significant increase from a year ago. And I know a lot of people talk about housing inventory, and they say, well, if people didn't have these mortgage rates, that they would just then they're not going to sell their house. But if person A sells their house and person B buys it, then where does person A live after they sold their house? They're going to need another home, right? Or they're going to go back to apartment rent, apartment living. I don't know. I mean, maybe some people would sell a secondary home, but I don't know how interest rates would necessarily impact those sales. So if a person is a single house owner and they sell their house, they're going to need another house to buy. It doesn't actually increase the inventory stock, and it doesn't actually work towards or works down the deficits in um, the housing stocks. So coming in, XLE versus S&P 500, peeking out of the major blue bull flag. Could be the beginning of energy, and yet again outperform the S&P 500. We've got the channel. The downward channel has been broken just recently. Nice, good support off this long-term trend line that he's got. Michael Zubar says, wow, so 68.7% of homeowners have more than 50% equity in their house. Clearly an over-leveraged market doomed to crash. This is Steve. It says, wow, the equity situation for American homeowners is astonishing. This is one of the reasons there will not be a flood of foreclosures coming to the market. Just saying. Americans are sitting on tremendous equity. 30% mortgage homes with greater than 50% equity. Mortgaged homes with less than 50% equity is 31.3, and owns the home free and clear, which is this. So anybody who is greater than 50% equity in their house is 68.7% of homeowners have more than 50% equity. It's not the least affordable in history. The early 80s were worse for housing affordability thanks to super high interest rates. But that's the only time that was worse than today, was right back here in the early 1980s. Yes. This is silver divided by SPY, or the S&P 500. Now a bigger cup to be filled. Silver to outperform the S&P 500. This is a double bottom in my opinion. And we've got a long way that we can work our way up. We came from levels that were way up here in the early 1980, late 1970s. We came down, came up, and then we went into a double bottom, and then we're going to break this hopefully to the upside. It's going to take some time, though. It's going to take some time. I've learned the hard way. You're better off not mentioning names you invested in to friends and family, as they can always copy the investment, but never the conviction. And having conviction in a volatile stock is everything. And I do agree. I mean, the best thing you could do is kind of work your way up and figure out why some good investors buy stocks. You say, well, why did you buy this one? Why did you buy this, this other one? The conviction is what keeps you in the trade. Anybody can go buy something. That is easy. You can't stay in it. Sitting and holding is the hard part. If you don't have the conviction, you could have all the best investments in the world and you won't be able to hold on anyway. So I would say that even if you're a lazy investor just trying to barely follow someone, it might not work. You really need to get close to someone and see and ask them, why are you doing this? Why do you still hold this company if it's down 20%? Why did you buy more when it was down 50%? Et cetera, et cetera. This is the pandemic. It says the pandemic bubble was dumb, but this AI bubble is even dumber. I completely agree. I think artificial intelligence is another bubble. People are jumping on it. And look at that, the NASDAQ 100, you get the pandemic move up with all the money printing, the first pullback. This is your bull trap in artificial intelligence. And I agree with him. It's going to go lower at some point. Could the point of number two exceed this pandemic high? It could. It's possible. We could also be doing a double top, which is pretty common. And we could see a large move to the downside afterwards. Why would we see a large down move? Well, interest rates could do it, or the housing market. If the housing market were to crash, it's going to bring everything else down with it. We're not there in the housing market yet. I still think we are some years away from that occurring if it were to occur. But there's other things in the market that could obviously throw things off. High interest rates. We were in a very low interest rate environment for a long time. Ever since about 2008-9, we were at very low interest rates. And a lot of companies were born under those low interest rates. They may or may not be able to be successful under a high interest rate environment. And that's what is going to be tested, I think, over the next year or two. And a lot of that stuff, it could be credit destruction, business loans going bad. That can also lead to a slowdown or a recession in the markets. When is the exact timing of that? How does it look like? Everyone tries to make those assumptions. They try to figure out when that's going to occur. They try to time it. A lot of them get it wrong. Like 99% get them wrong. So a lot of the times you just want to go with the real estate market riding through any short-term volatility because we don't know if those loans or some other area in the market could potentially slow things down. Generally through the real estate cycle, commodities go up all the way until we get a bunch of inventory. The valuations get expensive in relationship to stocks and other asset classes. And when the housing market slows down because inventory is high and the housing starts roll over, that's when you have to worry. You get about a year or two after the peak in housing starts. The peak in housing starts occurred in 2005. The crash occurred in 2008. That was a 3-year move, but we had inventories going up in 06, 07, and 08. So it takes a couple of years for all that to kind of work its way out. We haven't worked any of that out yet. So all the guys that are calling for a housing crash, I think, are premature by at least 2 or 3 years. It's probably greater than that. This is Kepler Chevreux, out with a huge new report, 82 pages, and guess what? It's bullish. Huge dividend growth ahead for a lot of the oil tankers. We got FRO, DHT, and EURN. It's owning a new regulation related to greenhouse gas emissions is what it's about. The order book for tankers is historically low, while the EU's ban on imports of Russian seaborne oil and products has led to structural changes in transportation patterns. That's kind of the gist of it. It says the only way to own a 10-bagger is to not sell after the stock has already risen 100, 200, 300, 400, 500, 600, 700, and 800%. So you have to be able to hold. You have to be able to value assets. You have to know what market conditions drive it up and what market conditions will drive it down. That is what I've basically set up through ratios and the market conditions and technical analysis. That allows us to see bottoms and it allows us to see tops with some sort of conviction and validity to it. Goldman Sachs, we estimate that global oil demand has risen to an all-time high in July of about 103 million barrels per day. We are rocketing higher in our demand for oil. Crazy. Here's Lance. He says at 40 times trailing 12-month sales, 25 times forward sales, NVIDIA is the highest valuation stock of any stock in the S&P 500. 231 companies reached similar multiples of the last 50 plus years. Only 20% beat market the next 12 months. Greater than 90% fail 3, 5, 10 years. They fail, guys. Medium stock loses about 36% next 12 months. So would I be jumping in NVIDIA at this high with these crappy valuations? No, I probably wouldn't even buy it with your money. Says the great majority of Americans with fixed rate mortgages have not been impacted by the Fed's rate hikes. Great information. It says only 11% of U.S. household debt has an adjustable interest rate. That means the vast majority of Americans with existing fixed rate mortgages, auto loans, student loans, have not been impacted by the Fed's 11 rate hikes. So very little impact from a U.S. household debt perspective from the rate hikes. It says, while I don't love it, Bidenomics seems to actually be effective for the new Dems. More jobs no matter the cost of inflation and a fiscal posture that will eventually force either much higher rates, lower asset prices, or much higher taxes or tax rates on rich. Both will address inequality. One thing I will say is jobs that are created by government destroy jobs that we never see. So they brag about the jobs they have created, but no one will know what part of the economy they had to destroy in order to create those, quote, jobs. Governments do not have any wealth. They do not create wealth. They can only take the wealth from others. And then they redistribute it, create these jobs, and say, look at the jobs I created. In order to create those jobs, that wealth had to come from somewhere, which is a destruction of other jobs somewhere else in the economy. The economy is weaker the more government creates jobs because of the effect that I just described there, which is they steal wealth from one sector, reallocate it to another, and then they have to continually reallocate to the jobs or the sector that they created those jobs in. Someone says, how do you create a future 10 bagger? By buying an X future 5 bagger after it dropped in price. That is what commodity stock investing is all about. Also, commodities go up at faster paces than any other sectors. Commodity equities do. So when they get going, you can get a 5 bagger or 10 bagger in a few years, depending on what the commodity cycle looks like. Sometimes it takes a little bit longer, sometimes a little bit shorter. We did, what was it, 30x in like just over about 2 years in some of the companies that we've been watching, like SM Energy. PR was another great returner, and some of these other guys. This is the average net worth by age, 76,436 between 35 44, 833,000 between 45 and 54, 1.17 million 55 to 64, and 1.21 million 65 to 74. What's your net worth goal? So that's the average net worth, and I'm sure it's a lot lower if it's the median net worth, because if you get a lot of really rich people in here, it's really going to skew the average to the upside. But I don't know. My goal, I don't really have a particular goal. I don't think it's worth even having one. I'd like to see, I'd like to 10x my net worth at some point. I'd love it. I'd love for it to happen earlier than later. It'd be awesome if, by the end of this commodity bull market in the 2020s, I were to 10x my entire net worth. That would be awesome. Am I leveraged enough for that to happen? I don't know if I'm leveraged enough, if I have enough companies with that type of movement for an entire portfolio, because I do have a lot of stuff that is not as leveraged, like a lot of physical metals and stuff like that. So we'll see, but I would say definitely a 5x if I could do that. Really good investment opportunities aren't going to come along too often, and they won't last too long. So you've got to be ready to act and have a prepared mind for when that does occur. A lot of fear in the market, you're going to have to jump on it. It says if you can step back and take a longer time horizon, that is the big secret. If you invest the way people gamble at casinos, you're not going to do very well. It's the long-term investment that works best, and that's your time horizon. Um, yeah, I'm not going to talk about that. Bitcoin's fortunes will only change if when this chart can achieve a breakout, and we are coming back below a lot of these support trend lines. And I don't know which. I think the Nasdaq will eventually roll over. I think Bitcoin will roll over as well, given the market conditions that I think are coming up. But that's what I've got for today, guys. That's where we're going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. I usually do these about once a day. It's something to do with market conditions, ratios, or news, or other charting that other people are doing, just to kind of cover the basis. It's not just me looking for opportunities. It's a wide array of people looking at opportunities and sharing those opportunities with others. There's a lot of value there. So X or Twitter, good work for combining or getting everybody around the world to share financial topics. And I think there's a lot of value there, but I also think it's dangerous. A lot of people share a lot of opinions that I don't think are necessarily right. I disagree with their opinions. Some of the things they do show are not complete. Like a few of the things I showed today, like one of them, the apartments. Is that enough apartments to cover the deficit? I don't know. There's nothing in there. He just said, "Oh, look at all these apartments. They're building a lot." Doesn't mean it solves the deficit though. That's just one thing. But that's all I've got, guys. We'll catch you next time. This is Finding Value.